And now our top story. U.S. stock markets tumbled steeply yesterday as hotter than expected economic data in the U.S. caused investors to worry again that inflationary pressures may be building in the U.S. economy and that the U.S. Fed may not deliver the rate cuts that the market craves. Let's talk about the state of the market with our featured guest of the morning, Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. First of all, Brian, thanks for coming in.
Great to be here,
What's
Paul.
your
Thank
take on the rate cuts that the market wants and the cuts that the Fed is likely to deliver?
Well, Paul, I think the market really needs to be careful what they wish for. Of course, we had this longing and pining for deep and rapid interest rate cuts on both sides of the border for much of last year. And to many, they came later, especially in the U.S., and smaller than what had originally been priced in and hoped for. But of course, that's a good news, bad news story.
Yes.
You know, you need rate cuts when the economy is struggling. And of course, the U.S. economy in particular has not been struggling. It's been very robust. So, I think investors are quite rightly repricing the likelihood of big and soon and deep cuts to interest rates, especially in the United States, because by all accounts, the U.S. economy is quite robust and growing nicely. It's kind of a two-speed economy, to be honest. The manufacturing sector there has been in contraction for 2 years and 3 months, which is a record length of time. Of course, we know that's related to all the demand that got pulled forward, people buying goods when the service sector was closed. But fortunately for markets, for investors and Americans, the service sector is 3 or 4 times larger than the goods sector, and it has grown rather steadily throughout the last couple of years and really has helped the U.S. stem and skirt a recession altogether. And again, we got another data point yesterday with that ISM services survey coming in above 50%, meaning service sector purchasing managers foresee ongoing growth. And then also yesterday, we got the JOLTS, or job openings and labor turnover survey, coming out with higher than expected job vacancies, indicating a still pretty hot or tight labor market. So it's giving investors pause to reprice their expectations for rate cuts and push out the timing of them. So now, whereas just a month or two ago, investors were pricing 4 rate cuts in 2025 by the Fed, now they're thinking it might be more like 1 or 2. So I think you got to take it with a grain of salt. Markets can be wrong, the Fed can be wrong, and things can change quickly. But based on the way things look now, we're not going to be seeing a lot of rate relief in the United States, and that's not a bad thing, even though the market sells off a knee-jerk response to it in real time, as it did yesterday.
Is a pickup in inflationary pressures a bad thing?
Well, yes, that is a bad thing. So price stability is important for investors, but really for Americans and Canadians at large, because our lives are lived and traded in nominal dollars, but we consume real goods and services, and so having a modicum of stability in sort of our expenses is important, and it is the primary mandate of both central banks. So the Bank of Canada has done a pretty good job of getting the inflation genie back in the bottle. We're actually below target on CPI, price inflation, sub 2%. The U.S. has still got a ways to go, and it looks like there are sort of percolating signs of intermediate price pressures that could ripple through to consumer prices, and that's another reason for the Fed maybe being a bit more cautious about timing and magnitude of rate cuts this year.
What are some of the risks that you see to this bull market?
I think you got to split it into both sides of the border. So the one that is most talked about, but frankly, we'd probably fade this risk, but it's important to acknowledge it. That's the trade and tariff wars, and that's sort of occurring on different battle fronts. So obviously for Canadians here, the Canada-U.S. trade tariffs, whether and how they're enacted, we think they'll be walked back from the big bluster and bully betting that's going on Twitter or Truth and Social or whatever it is.
How significantly walked back do you think they'll be? You don't think there's a possibility, for instance, of a Canadian recession triggered by tariffs?
Well, if the tariffs are enacted as announced, I think it almost assures a recession. But we think that cooler heads probably prevail. Recognizing that Canada's in a bit of a leadership vacuum right now with the announcement earlier this week that the Prime Minister is resigning. But it's more likely than not that his successor is going to have more in common with his U.S. counterpart than the outgoing Prime Minister did. But at the end of the day, trade and tariff wars are mutually assured economic destruction, so it's really in no one's interest. No one wants this. And it's kind of like a poker game. You play the man, not the cards. And so we have 4 years of prior experience dealing with the Trump presidency in the first instance. And so we often saw a big say versus do gap. And so these big bully bets are sometimes thrown out there as a means of scoring political points or exacting concessions in other totally unrelated areas, in this case, border security and fentanyl and things that don't really have anything to do with trade. So there's centuries of cooperation, friendship and allyship. We're our biggest trading partners. We fought as soldiers in arms. And so it's just way too much at stake to let a very draconian across the board 25% trade tariff be enacted for any length of time. So we think the rational heads will prevail and we'll get something that's less draconian than that. That's not to say that Canada can altogether skirt a recession, because the other pressure to our economy is the radical ratcheting back of the population growth that we have seen over the last 3 or 4 years. So even under the outgoing Liberal government, the very clear intention is to dial back temporary foreign work permits and student visas. And so, GDP, gross domestic product, is a function of productivity per worker, but also the number of people in the economy. So if we're actually going to see the Canadian population shrink, if people do leave when their permits expire and so on, that creates a headwind to Canadian growth. So we're going to want to see a bit of Bank of Canada relief, and we probably will, to mitigate some of those headwinds.
What is your take on the central question for investors, multiples, particularly in the U.S. market, and whether stocks are fully priced or not?
Look, I think if you just look at it in the absolute, U.S. stocks are not cheap. They are in the highest quartile or highest decile of their historical valuation. And I want to frame that correctly, Paul. When I say that, I'm talking about the price to earnings multiple on the S&P 500, which is not the entirety of the U.S. market. In fact, increasingly, it's become a very, very, very concentrated benchmark where 7 so-called Magnificent 7 companies comprise 1/3 of the weight of the equity index. So to a degree, those companies and the investor effect and affection they have for them is skewing the valuation upward for the whole market. But we think there's good mispricings to be found in the other 493 stocks. But sort of taken at face value, U.S. stocks are historically rather richly valued, particularly when you consider the disparity in valuation between U.S. equity indices and Canadian ones. The TSX, for instance, is trading at 15 times earnings. So that's a 40 to 50% premium that the American market trades over Canada. And we've not seen a disparity that wide this century. And, to be grandiose, let's say this millennium. So it's really quite an unprecedented divergence that we've seen between the two markets.